This is a floodplain. This floods on its own. It's crazy.
Swearing in employees.
Everybody had a good break, I hope.
Yeah.
52 days.
Anybody else ride a bicycle besides me? Bicycle. We're talking about losses. You recall that losses are talked about in the Income Tax Act in section 111. And we said that losses can be carried back and carried forward. Non-capital losses carried back how many years? Non-capital losses? 3. And these are regular losses from operations. And capital losses carried back?
3.
Also 3. And non-capital carried forward?
20.
And capital carried forward?
Forever.
Till the end of time.
Till the end of time. That's good. You'll do well in the quiz. Let's take an example about losses in a real life situation. So a person, an individual rather, is running a business and would like to transfer the business to a corporation. They've got legal advice, good legal advice, that a corporation would provide legal liability, protection, et cetera, et cetera. And at the end of the day, after this transfer, the business would be in here. Corporations being designated by rectangles. Here's the interesting part. The corporation, or rather the business, is anticipated to have losses for the next little while. This is not unusual for startups. In fact, they're called startup losses. So let's say we might have 2 or 3 years worth of losses, probably operating losses. And the client says, fine, please proceed with the incorporation, and then the corporation incurs the losses. And she says, well, it's my corporation, I'm the shareholder, presumably I can use these losses. No, we have 2 different taxpayers here, and the losses of the corporation happening in its early years, in its startup years, those losses can't be carried back to anything because the corporation doesn't have any prior history, no previous taxation years. And they also can't be carried anywhere for the benefit of the shareholder. We call those losses dammed up. The losses are dammed up inside the corporation. So you can imagine this being a dam and someone would like to breach the dam and use the losses up here. No can do. Thus, and now think of your lawyer selves. Good idea to ask before someone incorporates, hey, what do your financial projections say? Will you actually be making money right off the hop? Oh, and by the way, making money is a good thing incorporation-wise because corporations have lower tax rates. The benefit of having a corporation is lower tax rates. If they're going to be losing money for the next little while inside the corporation, maybe they should operate the business, continue to operate the business as a proprietor, and use any losses, startup losses, against the current year of the proprietor, and the proprietor can carry losses back 3 years. So an important lesson, I think, about the timing of when to incorporate. Any questions on that? We were talking about redemptions, also called
Buybacks.
share buybacks. And we were looking at section 84. Please turn there in the Income Tax Act. And I should tell you, I'm quite okay if you do this. When you're in class. I digress. We looked at 84.4, which is about reduction of paid-up capital. And essentially what happens there is we have a reduction in our paid-up capital and a reduction in our adjusted cost base, and no other tax result. No deemed dividend, nothing like that. Scroll back a page to 84.3. And here we're deemed, so says A, to have paid a dividend equal to the amount, if any, by which the amount paid by the corporation, so how much cash we got, exceeds the paid-up capital of the shares that were redeemed, that is, bought back by the company.
Yeah, I have a question.
Yes,
When a shareholder, is it the shareholder that elects to either withdraw paid up capital or a dividend, or is it the corporation granting that determines that?
it's normally the shareholder. A corporation can ask for its shares back if the shares are so-called redeemable shares. That does happen. But in the context, that happens mostly in public corporation scenario and can happen with private, but the more common private situation is that the shareholder says, I'm giving you the shares back, please pay me, so it's in the other direction. Please buy back my shares. And we call that retractable shares.
So the common situation for private is the shareholder will either request their paid up capital or not. It would just be a regular dividend at that point.
Shareholder goes to the company and has three choices. Pay me a dividend, redeem my shares, or reduce my paid-up capital.
Okay. And are they able to request a partial PUC reduction and dividend? Like if I have 10,000 in paid up capital and I want a $30,000 dividend, can I have 25 deemed and just reduce my PUC by 5?
Short answer, yes.
Okay.
Anywhere between 0 and 100% of the PUC,
Then that would be tax exempt, of course.
that's right. We would call that actually a deferred tax because it would also reduce our adjusted cost base, so that someday when we sell the shares, we'll pay tax on a capital gain that we wouldn't have had otherwise.
Okay.
But we're happy to have that situation because we're getting cash today without payment of tax on it. Here's a situation where an individual originally years ago subscribed for shares of a corporation, let's say all the shares, this is all the shares of the corporation, and put in $10,000 for those shares. The paid up capital of those shares is $10,000. The adjusted cost base is also $10,000. In other words, if the person were to sell the shares rather than have them redeemed by the company, there would be a capital gain of share proceeds minus adjusted cost base, which is $10,000. So in this scenario where a person is the original subscriber for the shares, the adjusted cost base and the paid up capital are the same amount. Shares get redeemed by the corporation at their fair market value, $100,000. Result is a deemed dividend of 100 minus 10 is 90. The corporation shall be deemed to have paid a dividend equal to the amount, if any, by which the amount paid by the corporation on the redemption, 100, exceeds the paid up capital in respect of those shares immediately before that time. So deemed dividend, $90,000. There's also a capital gains transaction here. That transaction, and capital gains transactions are proceeds minus costs. Proceeds, whatever that is, minus adjusted cost base equals gain. or loss. In this case, in the case of a redemption, the proceeds, the deemed proceeds, is the amount of the fair market value minus the deemed dividend. Please write that down. It's the fair market value minus the deemed dividend. In this case, that's 100,000 minus the deemed dividend of 90 equals $10,000. So we have proceeds of 10, and our adjusted cost base, which I said earlier, is 10. So we have zero gain or loss. Zero gain or loss. Now I'm going to go really slowly here. If anybody has any questions, take your time. So in summary, two transactions for tax purposes. The first is a deemed dividend governed by 84 sub 3. The second is a capital transaction of however much I got for the shares, 100, minus the deemed dividend. So it's measuring, look, I got 100, and of that I'm paying tax of 90 on the deemed dividend, and now there's a potential to pay tax on the 10, depending on what my adjusted cost base is. But my adjusted cost base is 10, no gain, no loss, no harm, no foul. Okay with that? Now, let's say I'm the second shareholder. Let's say that the first shareholder put $10,000 into the company, got paid up capital and adjusted cost base of 10, and then sold those shares to me for $40,000. Sold those shares to me for $40,000. So the first shareholder had a capital gain of $30,000 and whatever on her or his tax return. Now I'm sitting here with the same shares, and my adjusted cost base is 40. Everybody see me change this from 10 to 40? The paid up capital of those shares is still 10. The paid up capital hasn't changed. The amount put into the company in the first place, still only $10,000 because it's based on history when the shares were originally subscribed for. Now let's do this transaction. Redemption, $100,000. Still have a deemed dividend of 90. Still have a deemed dividend of 90. I'm thinking, boo, because I paid 40 for these shares. Now you're telling me I've got taxable income of 90? And up here, I have proceeds of 10, same proceeds for the capital gain transaction, which is 100, the cash paid on the buyback, minus the $90,000 deemed dividend, $10,000 proceeds. Adjusted cost base, 40. Gain or loss? Loss of 30. Shareholder says, awesome. I'll deduct this loss against the deemed dividend. No, it's a capital loss. All you can do with it is carry it back or forward against capital gains. Damn it, when I bought those shares, I wish my lawyer had pointed out the fact that all I'm getting for those shares is adjusted cost base, not PUC, because 5 years later on this redemption, I'm paying a whole whack of tax that I wasn't expecting. I figured my sort of tax value of these shares is $40,000 because that's what I paid for them, but that only counts for the capital gain transaction. It doesn't count for the paid up capital transaction. Now, probably the share purchase still should have happened or something like that. I mean, it was a good deal for the person who bought the shares and the right price and everything, and you helped out with the negotiations and so on and so on. But as a matter of information, it would have been helpful for the now shareholder to know sort of what the tax ramifications are of a redemption if a redemption would happen someday. Please turn to 89 bracket 1. definition of paid up capital. $89.1 is a huge definition section. If you're ever thinking you need a definition with respect to CCPCs, it's probably in section 89. Definition of paid up capital. In respect of a share of any class of the capital stock, an amount equal to the paid up capital in respect of the class divided by the total number of shares.
That's it.
Here's a shareholder that put at the beginning, just like our previous example, $10,000 into the corporation. Got shares for $10,000. And then goes to perhaps the same other person we spoke of earlier, and say, hey, instead of buying my shares for $40,000, would you like to buy new shares from the company for $40,000, however many shares that is at today's value? Sure, why not? A share redemption happens. Let's say this person redeems their shares. Let's say they get $100,000. Say, awesome. I know there's a deemed dividend happening here, but I put in $40,000 into the company. Presumably my deemed dividend is only $60,000. No. We take the amount equal to the paid up capital in respect of the class of shares, which is a total of $50,000. And let's say that these people each have 50%. This person's paid up capital, and she paid $40,000 for her shares. Her paid up capital is only $25,000. This person, who only put $10,000 in, her paid up capital is also $25,000. This person wins in the respect of if everybody's shares got redeemed, this person would get more protection from deemed dividends than this person per dollar of paid up capital put in. I kid you not. This person goes to her lawyer and says, are you kidding me? How is it that I have less paid up capital than what I put in? I thought the paid up capital is what we put in. Very easy fix right at the start when these shares got redeemed, when these shares got issued for the new shareholder, new class of shares. Because paid up capital is calculated based on a class of shares. If we had class 2 shares, we would do a different paid up capital calculation. And if she were the only shareholder of class 2 shares, her paid up capital would be 40, which is what she wants, not 25. 1, 2, 3.
So in this situation, though, the person who paid $40,000 in would have the same number of voting shares as the person who put in $10,000.
That's right.
So they have effectively paid 4 times as much in for the same number of shares.
Which was what they agreed to.
Okay.
Can one person just keep getting new classes of shares almost like an endless?
That's up to the lawyers. And what I mean by that is it's actually fairly easy to have different classes of shares that are almost the same. And I've seen it done, for example, where on the dissolution of the company, let's say this person gets repaid first, followed by that person, something like that. Hopefully with regard to a contingency that might never happen. But at least we're putting enough daylight between the terms of this class and the terms of that class to be able to say to CRA, yeah, we've already got 2 classes of shares here.
My
question was a tie into that, and you sort of answered it. I was going to say in Class 1 and Class 2 would be identical in function, but just have a different title for the sake of PUC.
No, not just a different title, they need to have different terms. But there is such a wide range of available terms, everything from votes to dissolution power to you name it, that it's, maybe timing of dividends paid, those types of things. It's fairly easy to accomplish a different share term and therefore a different class of shares.
Was that regular practice for that to happen, just for the sake of PUC differentiation? Someone will make it very minor.
Yes.
Ah.
Yep. Another way to do it, or to get the same protection, is, I'll redraw the whole diagram. So here's the original person. Sorry, this is the corporation, original shareholder. New shareholder says, you know what? Instead of holding these shares directly, maybe what I would like to do is hold them through a corporation. In which case, even if there's only one class of shares and I get disadvantaged by this PUC problem, at least whatever deemed dividend comes up here escapes Part 1 tax because of 112 bracket 1, and maybe also escapes Part 4 tax if there's no RDTOH down here. So this is one way to beat it, to beat the problem and not have to deal with trying to dream up a second class of shares. Again, it's up to the lawyer to say, okay, look, you're subscribing for shares of this company. There's already an existing shareholder of this class of shares whose PUC is a lot smaller than yours, thus yours will be diluted. So let's do something about that. Let's negotiate either two classes of shares, or let's have your corporation buy the shares or something in case of a potential redemption someday. Oh, and as I said earlier, the redemption is normally at the control of the shareholders. We call that a retraction, actually. But also a corporation can redeem its own shares at will, which perhaps I can vote against, but say if I'm a minority shareholder, I may not have any control actually over the timing and value of a share buyback by the company. Thus another reason why this holding company idea might be a good one. Any questions? Please turn to page 511 in the textbook. One of you asked me a great question a few weeks ago. Oh, let's talk about taking money to the company and we're paying dividends. Will we have to worry about eligible, non-eligible, RDTOH, not, deemed dividends, reduction of paid up capital? Why don't we just have the company loan us money? Which is awesome. I mean, why not? A loan is not a taxable transaction. Well, the Income Tax Act thought of that. And there is a problem which is on the bottom of page 512. Please go there, and you're looking at the paragraph that starts, a corporation is not precluded from loaning funds to shareholders for reasons other than those mentioned above. First thing is, I don't need you to know about the reasons mentioned above, which are about things like home purchases and stuff like that, which are relatively infrequent. I want you to know about the more frequent situation, which is when a shareholder says to his lawyer, hey, why don't we just borrow money from the company? The loan must be repaid within 1 year after the corporation's taxation year in which the advance was made. I'll get to the punchline. If it's not, it's taxable income, believe it or not. It's got to be paid within a year of the end of the taxation year of the corporation. If not, it's taxable income. let me show you on a timeline what this means. Let's say we've got January to December 2020. Okay? The corporation's year end, not the shareholder, but the corporation's year end is, I don't know, October 31st. During that year, I borrow $100,000 from the corporation. Straight out borrow it. We signed a promissory note, everything, like it's a real loan, it's a bona fide debt. My lawyer says fine. In fact, it was the lawyer who drafted the promissory note. Thus, you have some control over the situation because you've been consulted. But you have to repay the loan. And the answer or the question is by when. So now we're going to go into 2021. And the loan was taken out here on February 25. The loan is within the corporation's taxation year ended October 31st, 2020. We draw a marker here, and by the way, when you're doing exams, I'd love if you draw this time thing. It'll help you enormously. I draw it all the time myself. The key date here is October 31, 2021. The loan has to be repaid by this date. The loan has to be repaid by this date. October 30, 2021. By the way, this date has nothing to do with February 25. It's got nothing to do with the date that the loan was made. So it is incorrect to say that the loan can only be for a year. It can be for a year, well,
360, a year plus 365 days, if it's a leap year.
it can be for a year past the corporation's taxation year end, which can be anywhere from 367 days if it's a leap year to whatever 731 days.
But if the loan was granted on the first day of the corporate year,
Let's call that November 1st, 2019.
yeah, then it would, right?
Yep,
Or sorry, yeah, 2019. It would still be due 2021, right?
that's correct. So that's
So
almost 2 years.
Almost 2 years. So it's 2 years minus a day.
Correct.
Okay.
So the takeaway here is it's not the individual's year end, which is always December. It's the year end of the corporation plus 1 more year. Please turn the Income Tax Act to 15 bracket 2. I'm telling you, this is one scary section, 15. And it's scary because it's counterintuitive to your clients that they should have to pay tax on a loan. They just can't get it, so often this has to be explained to them that there is actually a rule, and it's okay to do this, but there's a timeline that has to be respected. Where a person other than a corporation resident in Canada. So here we're almost always talking about an individual who borrows money. Could also be I was going to say a partnership, but that's not a person. It's almost always an individual. Is a shareholder of a particular corporation. And the person, oh, pardon me, or partnership. Oh, good, it is mentioned. Because a partnership's not a person, has to be. And the person or partnership has in a taxation year received a loan or become indebted to. Pertinent loan is one of the ones covered in the earlier parts of page 5, 11, and 12 that you don't need to know about. The amount of the loan or indebtedness is included in computing the income for the year of the person or partnership. For the year, what does that mean? Which year are we talking about? The year in which the person received the verb there, received the loan, that's the year. So let's see how this plays out. This person borrows money on February 25, doesn't repay it, let's say until about 2022. This person has to refile their 2019 tax return. Pardon me, 2020, because they received the loan in 2020. So even though for the purpose of determining the timeline, we look at the corporation's year end, if this thing gets included in income, it gets included in the income of the individual in the year that the individual received the loan, which in this case is 2020. Thus, again, the repayment happens in 2022. Got to refile a tax return for 2 taxation years before. Any questions about that?
So for the taxpayer, what does that look like? Is that 100,000 added to your income?
100,000 added to income. No tax reduction for it being a dividend, like no dividend tax credit, which an individual would get if it's a dividend. You remember from the integration charts, dividends are taxed at like 35 or 41% if they're eligible or non-eligible. This is straight up tax at whatever their personal tax rate is, which could be 50%, and the corporation gets no deduction for it, which the corporation would have got a deduction at least if the corporation had, say, paid a salary or bonus. This is an awful situation. It is devoutly to be avoided if you can. Shareholder loans, not a good thing.
I have a question. With the corporation, in that situation, with the corporation, would it be in the corporation's benefit to issue that shareholder a dividend on the day before their year end, just to cancel out that debt to ensure that they can still get some money back from that?
Yes. In fact, it would be good to do almost anything to provide the shareholder with money, short of reloaning the money or something. So a dividend at least would give the shareholder a better tax result and might get the corporation a dividend refund. A salary to cover this, or bonus, would be the same taxable income in the shareholder's hands, just straight up income, but at least the corporation would get a deduction for it. Everything is better than this. Yes?
Can you, as a shareholder who's getting the $100,000 loan from the corporation, add it as your income when you're filing your taxes right away, so that you're ready to pay taxes on it, and then if you do repay the taxes within the time period prescribed, can you just get a refund in 2 years' time?
Short answer, yes. But no one would plan to do that. I mean, they no one would plan. Yeah, we like to defer tax, not prepay. Please go to 2.6. is what gives us that year after the end of the taxation period. I'll let you read it at your leisure. Going back to this one for a second. Let's say again that this person repays, but later than October 31st, 2021. They repay sometime in 2022. Result is what I said earlier. Got to refile the 2020 tax return to include the amount in income. Client says, well, okay, now I've repaid it. I got income over here. Can I get a deduction here? Short answer, yes. Please turn to 20 bracket 1 bracket J. You recall the preamble here is for the purposes of calculating income from business or property there may be deducted. Such part of any loan or indebtedness repaid by a taxpayer, as was by virtue of 15(2), including in computing the taxpayer's income for a preceding taxation year. So section 20 is a happiness section, and this is a good thing. Okay, so far? Read the last 4 lines. If it is established by subsequent events or otherwise that the repayment was not made as part of a series of loans or other transactions and repayments, which for me is the second scariest provision in the Income Tax Act. Person says, hey, let's borrow, we'll repay, then I'll immediately borrow again. Their second repayment might be in jeopardy, and honestly their first repayment might also be in jeopardy, or the deductibility thereof. I can't think of a situation when I would want a corporation to loan money to its shareholder for this reason. And I've had a lot of people promise me, hey, I'll only do it once. And it's just too good a habit. Oh, tax-free money? Yeah, I'll just turn this around. Yes.
What, I'm sorry, you lost me when you said deduction. So it's 100,000 of taxable income.
Back here,
Back there, where is the deduction coming?
2022. In 2022, when the repayment is actually made,
Okay. For
There-
the full amount, I would assume?
such part of any loan or indebtedness repaid.
Okay.
Could be the full amount or half the amount or however much gets paid.
Okay. But that deduction only applies to income in that personal 2022 tax year when it is repaid, right?
Correct, it's a deduction against that income.
So if they don't make $100,000 in income,
Non-capital loss.
yeah. Okay.
Yes,
It seems like the only benefit of the loan is just short-term, probably low, or it's no interest, is that?
correct. And please, not often. Seriously, any subjective, whether something is made as a part of series of anything, and we'll talk about this phrase in other sections as well, is subjective. And CRA will be incented, obviously, to try to tie loan number 3 to loans number 2 and 1. And we're trying to untie them, and honestly, they've probably got the better argument.
Okay. So this particular 21J, is the situation where the first $100,000 loan goes on and it's only counted as taxable after? Or is it counted as taxable and then immediately, if it's repaid in that year, in that corporate year, does this kick in? Or is it just like completely exempt?
Let's do this. Let's say the repayment happens in 2025. I'm now trying to disassociate the timing of the inclusion of taxable income with the timing of the deduction. Hopefully this will help you. So this date is now long past. We now have an income inclusion in 2020, and too bad. We finally scrape up some money to repay. The loan is still on the books of the company. The loan hasn't been repaid yet. It's still on the books of the company. We scrape up enough cash to repay it in 2025. In 2025, we'll get a deduction. So the timing of 2025 has nothing to do with this timeline. It's just whenever we repay the amount.
My question was on the other side of that 2021 date. So they borrow the money on February 25th,
2020
2020, and then they pay it January 1st
of
the next year, 2021. They pay it January 1st, right there. Is it exempt from tax, or is it included in income and then deducted?
it's exempt from tax in the first place because 2.6 exempts it. Go back to 2.6 for a second. So 15.2.6. So 2.6 is a good thing, right? It tells you that if you do something, you'll get exempted from 15.2. Unless the repayment, again, was part of a series of loans or other transactions and repayments. That's the same phrase we had in 21J. It also applies to 2.6, which is the thing that gets us off in the first place. Scarier than hell. Honest to goodness, really scary. Series of loans and repayment messes you up in, well, two different ways that we've seen. And series of transactions will mess us up at least once more in this course.
It seems based on that language too that there's an onus on the taxpayer to disprove that it was, like to prove that it wasn't part of a series of events rather than for the CRA to prove that it was.
When the lawyers come back, which will be in April, and CRA will also March, pardon me, we're going to have a discussion on onus and reverse onus. But yeah, for the sake of your question, this is on the taxpayer to prove that it's not a series of loans.
Sorry, I was just going to ask if there was a prohibition about forgiving the loans, and I think I'm reading it on 2.5b, that there must be an honest attempt to repay the loan or something.
No, 2.5b is a different situation for a different type of taxpayer, a trust.
So is there a prohibition for the corporation, against the corporation to forgive the loan?
Oh, so you're
No.
saying, okay, I don't want to give you $100,000 as a dividend. We're gonna pay tax. I'll just give you $100,000 as a loan,
And then I'll forgive it after.
Oh, yeah, it's all good. It's all
Yeah,
good.
well, the shareholder has already been hit for the same tax result as a forgiveness would be. The shareholder gets a benefit essentially. Shareholder already paid tax on it because of 15.2. Corporation might actually get a capital loss. I'd have to think about that. There's probably something that precludes the capital loss, but that would be the best possible outcome. Still not good, because again, 15.2 is the worst possible thing. Full up inclusion in income, no dividend tax credit, no deduction for the corporation. And please draw the picture, it'll help you immensely, I promise you.
Dan, if you've calculated that you've got a low tax year this year, and so you want to bump that up for taking money, and if you're going to have a really high tax year in the future, and you want to use that credit to bump you down a bracket, would that at all be valuable, or is it worth the cost?
Just in case you didn't hear the question, what if we've got a low taxation year here, that is a low rate taxation year, and a higher rate taxation year here? Let's take income here and low tax rate here, high tax rate there. Income here, deduction there. I wouldn't call that a planning scheme. 15, we can probably find a better way to do that than 15.2. Just want to close our discussion on section 15 by taking us to 15.1. Shareholder says, well, look, rather than taking a loan or anything in cash, why don't I just take a truck or whatever it is that the corporation's got? We'll just stick it in my name. So what happens here is that the value of the truck gets simply included in our income, which is just as bad as receiving cash. Actually, it's worse because now I got to come up with cash to pay the tax. What do I do, sell the truck, or I don't know. So 15.1, if at any time a benefit conferred by a corporation on a shareholder, is conferred, then the amount of the value of the benefit is included in the computed income of the shareholder. So not the cost to the corporation of the thing, but the value of it. Now the corporation would have a deemed disposition here, so the corporation might also have a capital gain or recapture situation or something. The takeaway from this is that in a non-cash transaction, we still have something bad that could apply to us, which is 15.1. And now we don't have, again, a deduction as if we had a salary. There's no dividend tax credit for the individual shareholder, et cetera, et cetera. Page 469, please turn there briefly, has a good discussion on this as well. Distributions other than cash. Why don't we stop there and have a quiz at 2:05, please?
I'm a little confused over the whole eligible non-voters. I don't know why, but it's like I have a little bit of. So,
Let me show you something.
They should do that more often. Case. Case-based interviews.
Yeah, I think it's really cool.
You were gonna need, they do that
So,
for lots of the conferences.
This whole RTOH,
Yeah.
yeah, and just even, like, is the dividend eligible or not, and then mixing in the 30, it's just,
Okay,
They're gonna like that.
let's start with
Yeah.
the further.
Yeah, it'll just be like a little case comp. I think that's valuable though.
Oh, for sure.
you know,
Like, when you say like, well, they're like, no, it
So,
didn't. Or
there's two
like,
types
well,
of
the judge
judgment
goes
around,
against, like, no, it wasn't.
Is the street meet?
That's why you can't say.
And also CCPCs.
Actually, honestly, the tax court decision on the Cupster case was really
It
good.
doesn't qualify for the small business.
Dollar
So, for example, everyone also serves.
Yeah, this one was, if I had, yes, I don't think I put the federal court when I just interviewed her, because she kept harping on how she wanted like,
So these are both
get a good deal, that's
general.
what it's like, she was like, yeah, you're really impressing me, I have confidence that you're gonna do it. I'm happy to go.
Yeah.
So if someone says that, it's like, okay, that means you're not getting like.
Like you're not for me, but I think you'll do well with somebody.
Yeah.
Oh, yeah, like,
But it was, I could. Yeah, and then tax court, tax court, but then the federal court keeps going, like, I could be getting in.
and you said that's the accountant's role is to determine.
No, this one went really well. She just said that at the end.
And
No, it felt really good.
it's a good thing for
But I
shareholders. Because eligible dividends have a tax rate to the shareholder as compared to also 35 versus
Would you rather see a tax court than?
Are those the numbers?
I would work for that, but
No, I
like, I mean, the
Okay,
subject material is less cool, more administrative, like, almost all
So
of her
then,
work,
well,
almost all of her work is racial
the only other thing is
administrative.
Yeah, I didn't know
Immigration
that
specifically.
if the company's got grit,
Yeah, I know.
What?
But,
generally.
yeah, I had a,
On what? Why are you looking at interest rates?
oh, what's that? Was that your actual rating?
Why were you
Oh, okay.
doing that?
Happy
Security.
So let's say we had, for example, $1,000.
By house?
Next time I do. I think it's better to own that.
And we pay a dividend,
That's good, that's better. Maybe I was there. Yeah, yeah, exactly.
720.
Can you finish it?
Assuming that this is
Yes, you're like that.
But I'm also going to spend it. And so Copscore is essentially really short.
So
They're
that's
like-
first of all what.
It's a vertical amalgamation. When you do a vertical amalgamation, you do.
Yeah, I'm thinking more sense
Sometimes
to
you do
have a
horizontal
parallel.
amalgamation, you don't do
I'm doing
By general rating,
Well, first of all, you're taking the business.
Yeah,
Yeah.
it's one's acquiring the other. Right, when you do a horizontal amalgamation, you don't do it. Right, so they do a corporate restructure, and they say, okay, instead of having parent and child companies, rather choose your company in a larger corporate hierarchy. And thus, and they do that for that reason. And so for that reason, they're trying not to lose money. The fund they're trying not to lose like 69 million. And so, and these are a bunch of foreign shareholders. And so they're, and they can take out that tax for you.
Yeah, and so it's to the left of there. But it's like a
So,
because I didn't
that's
there
the
was.
question that is the application of
Of course, I clarified that, because that's the transactional date.
Depends who you talk to, if it's a series of transactions. The tax court said yes, the federal court said yes, and the Supreme Court said yes. So they all have different levels of analysis. Luckily, I'm allowed to bring
It
notes.
wasn't too bad actually.
I'll bring notes at the interview.
I have one sense, but this one, and this one's April
I had
30th.
Samsung and I got an LG. It's just like.
I hope they focus more so on the bar application rather than the facts. Although I understand corporate
April
finance.
13th.
Yeah.
But Gar will, I think, yeah, they will.
Did I show you?
No, it's the Monaco, right?
It went pretty well.
So what this generally
like I'm sure you
is
experienced
like
in
this
town where
type
you're
of.
having like the Toronto East Coast.
Oh, I didn't realize that happened, that's inspiring.
Yeah, that was just one of the weird things where, like, it wasn't necessarily
Well, yeah,
just the
stock-
panelists.
yeah,
just
well, I didn't, it's like, what
So,
are we
like,
gonna
like,
do?
they just come up with one of the actual. And then if we can get some feedback, which is efficient.
Caitlin, you was there was a comment made on that deal that you made me actually laugh out loud.
I'm sure they were a little more.
I posted that and then I thought, okay,
So to-
Is everyone gonna know?
yeah, you know, like, this asshole.
I was gonna like jokingly comment something aggressive back, and I was like, are people gonna think this was like
Toronto once.
That would've been funny, I would've laughed at that. We missed you guys.
Yeah, no, I couldn't walk. I would have really liked to go. It was
So it's all
I had just had the surgery in January. Now I'm itching.
Yeah, it was really good. They did a deep program.
Yeah, I did quite a bit of rehab. So I was I can't run or anything. But like, yeah, it's not bad. Oh yeah, full time. It's no big deal.
It's like a.
I had some of that.
Like, you know, like.
Yeah. Well, like when I first did it, I had like a partial, like a partial tear or whatever, but a bunch of stuff all together.
Oh,
So like, it happened to me, right?
That's where we went after the gala dinner.
Yeah, that wasn't bad. I wouldn't have had anything left. Teddy Bridgewater.
That's what I mean, I think that if you go there, I would say.
Yes, that's a key
Like,
part of
because
it.
something that I was not.
Go ahead.
And the only reason I like it is leaving.
That was a lot of fun. If I wanted.
That's something, I wish it wasn't quite as large as the August.
This is huge. This is the Navajo.
Oh, yes?
Confusing watch. That thing's confusing. I said it once, I haven't touched it again. Cool thing about this is that you can change your destination, your place where you're leaving, and
Oh, yes.
so it's almost like a GMT, but digital.
So I'm looking at a launch sheet that's got a, it's called Melodies.
We'll talk after the last one. I got another pair of bracelets you might like on Instagram.
This doesn't store these guys.
But you're doing
Yeah, see the portion.
I haven't paid any taxes.
The simplest personal finance we got to do that.
So is it the 72 just applying to our own, or is it also applying to?
Or just save.
No, it's 100 of
Or
it.
just save. Discretionary spending is actually what hurts you in the long run.
And
You
then,
can decide to either spend or save. What would you do?
yeah, what you just said is a key insight.
No,
The
some
fact
people
is that
have that mentality. If I've got money in my pocket,
it's also critical.
Something smart about your finances. Well, no, but spend lots on like things that make you really happy, right?
Now we're
Spend
entitled
some money
to
on
both
wants
the
that make you
dividend.
really happy. You have to realize, okay, I'm not gonna go out to dinner instead, right? You have to.
You'd be like me, I'm a hermit.
And that's called the eligible RDTO, which
Like a hermit who cares the money.
No, I'm not worried.
I found some of the numbers really surprising. Millionaires drive on average $30,000 for cars.
Number one car,
Probably gonna get a nice car.
number one car, Honda.
Yeah, this one on this too. That's been a dream of retiring at 44.
I think that these
I don't want to have a
Being
retire.
self-sufficient for the rest of my life.
I don't want to retire.
But it's just a general, so if you're.
I always want to do something.
Well, yeah, he's like, we go traveling and blah, blah, blah. And I'm like,
It would be nice to sip margaritas on a beach for like a
eligible
week, and
RDTO
then you'd be like, wow, I need something cool.
is
and your mind just deteriorates.
Part 4 tax payable on eligible dividends received from non-Canadian. Here I'm quoting from page 503. Actually, take a
Well,
picture of that.
Necessary shot.
Too bad you didn't bring home a cup, but good job on the move regardless.
Yeah, has Manitoba ever?
No! Don't check too.
No, I heard.
Thanks for taking the time to show me.
This is where
Okay, so calculate your income, start with section 20, right? Which says that your income for the year is going to be profitable after tax, right? So, what's that? Income tax, so just start with that. I expressly
Filling it with 100% of the eligible dividends. And then we pay part 4 tax on eligible dividends.
not allowed to have
Here
some
for
actually appreciation, but they're real.
Okay, that's making sense now.
We have our eligible office supplies.
Oh, yeah.
That's very broad. It was very broad. But so then we get to some specific parts.
That's
So
why we
so
get
you
that.
add inducement, you have to add anything that makes sense. So that's like, that's one of the things, right? So like the MLT.
Yeah,
it's
so I think you're right now.
If the,
Yeah,
if
it's
the,
that- that's
uh,
what
company
it is.
will
And the only reason it's
$1,000 will knock $10,000 off. You have to include that income that you receive.
Oh, even, I thought even,
No, well, yeah.
I thought it was only like actual incentives.
Dan,
Oh, 100%, you probably have.
yeah, really quick one. So an inducement payment, if they're not actually paying you money, but they're deducting money, if they're giving you a discount, is that including income as well?
yes.
But you get a lower rate anyways. You're getting a lower rent payment, so that's where the difference is, right?
As far as the
But
promise
but
of the
an
short one.
inducement is an upfront thing. It is typically made in one payment, not just to reduce.
But if they go like, instead of giving them a cash equivalent, they just reduce the rent payment, that's already included in the reduced rent payment, right? So you're getting that two rent There you go, that's what I was thinking.
And then section 23 allows the deduction of interest on like long-term assets, and if you have like an expense during financing, that's deductible. Taxable income, so you start with net income to get to taxable income, you deduct deduct charitable income,
Causing a massive amount of
Yeah.
damage.
I'm really hoping to be able to
dividends from
Yeah.
they're not taxable.
Okay, you're saying from another.
Charitable donations are deductible up to
not of the donation itself.
Well, that's what they're saying.
Net capital.
Well,
And then, so net capital losses can be carried forward, carried back 3 years forward forever.
I love that. So do I, so do I.
Absolutely.
Back carried forward forever. Capital losses back 3 years, non-capital back 3 years. And then the next thing, wait, we're not done yet. To take money out of corporation as much away, dividends, profit, and so dividends can be for capital dividends the most, eligible dividends, non-eligible dividends, eligible dividends, eligible dividends,